Subscribe to our YouTube channel and press the bell icon to get the latest updates.
Hello everyone, Rahul here, trying to make investing accessible and profitable for the average investor. Now imagine that you are on an island and suddenly hundreds of boxes start being dropped on the island through an aeroplane. Now, what do you think would be in those boxes? Some of you would think that there would be food. Perhaps there is a drought on the island and food is being airdropped in boxes. Some of you would think that maybe it's first aid kit or medical supplies, or could be any other emergency supplies. But can you ever imagine that there are tens of hundreds of cats in those boxes? Cats being airdropped from an aeroplane packed in boxes. Now, this is not a figment of my imagination. This actually happened, and it was called as Operation Cat Drop. This incident happened on the island of Borneo about 3-4 decades back, where the World Health Organization had to airdrop cats in boxes on the island. Now, the reason they had to do this was because there was a case of malaria. There was a malarial outbreak on the Borneo island, and in order to bring it under control, the World Health Organization had to take up spraying of DDT. They had to cover the entire island in a thick dust of DDT, which they felt would, of course, kill the mosquitoes. Now, the DDT did kill the mosquitoes, but something else happened. They also led to the perishing of a large number of cats on the island. DDT not just killed the mosquitoes, they also killed the cats. And what happened subsequently was, because a large number of cats perished, the population of rats suddenly went up. Now, there was no one to kill the rats, and as a result of which, the number of rats went up. Now, the danger of a malarial outbreak was suddenly replaced by the danger or the risk of plague. And therefore, in order to bring this risk under control, or to bring the population of rats under control, cats had to be airdropped. Another similar incident happened in India much before independence, and I'm not sure whether this is true or it's a fictional anecdote. But what happened was, the Britishers, they started announcing cash rewards for anyone who would bring dead cobras to them. Now, the reason they did this was because the population of cobras was increasing at a rapid pace. It went out of control, and therefore they started rewarding people with money in case or when they bring dead cobras to them. Now, the same thing happened. The move backfired, it boomeranged. The population of cobras, instead of going down, it went up, because people started breeding cobras. They knew that if they would bring dead cobras to the Britishers, they would reward them, and therefore they started breeding cobras more and more. When the Britishers realized this, they of course cancelled this award, and what people did was they ended up releasing the cobras into the wild. So instead of the cobra population going down, it again went up. Now, these are interesting stories, pretty funny stories, if you will. And the common thread between both these stories is the principle of higher order or second order thinking. Now, none of the authorities in both these stories, they stopped and asked, and then what? There was a certain problem, there was a solution to it, but none of the authorities in charge, none of the people in charge of, these incidents, they actually stepped back and asked, if we do this, could there be another unintended consequence? Could this lead to something else which we fail to imagine, and as a result of which the solution actually ended up making the problem worse. Now, Howard Marks, in his brilliant book The Most Important Thing, has related this quirk of the human mind, or this bias, with how it leads to inferior or superior performance in investing. He says that he is of the view that investors should always engage in second order thinking, in high order thinking, if they have to put up a superior performance in the stock market. He is of the view that, if you think like the crowd, if you only have a shallow thinking approach, do not think about things deeply, then you may not be able to get a good performance. So if you think like a crowd, like what the rest of the people is doing, you end up acting like what the rest of the people are doing, and your performance is also similar to the rest of the market. And this is not how you end up having a superior performance in the stock market. If you want a superior performance in the stock market, you have to think differently than the crowd, and then that thinking or that decision has to be the right decision for you to have a superior performance. This he calls higher order thinking. Now let's try and apply this higher order thinking to a situation which I came across recently. A friend of mine, he sent me a breaking news WhatsApp message the other day. The message said that the Indian government has allowed foreign tourists to come into India. They have eased the visa restrictions. The message said that I think citizens of around close to 100 countries can now visit India, and if they are vaccinated, then they don't need to be quarantined. And the friend immediately, told me after that this news is good for a particular company in the hospitality sector, and we should go out and buy that particular stock because it's going to touch a new all-time high. So I think what my friend was doing here was he was employing first order thinking. He was not thinking deeply enough. He wasn't asking and then what, and because of which he ended up taking this. He ended up coming to this rash or rather sudden conclusion that because this news is out there, it's going to be a positive for the hospitality sector, and one should buy a certain stock from the hospitality sector. So I told him, hold on, now let us take a look at the price performance of this particular company in the stock market over the last 18-20 months. When I looked at the numbers, I realized the stock has already gone up 6 times from its March 2020 low. So it's already been an outperformer, a terrific outperformer. And then I had a look at its fundamentals, which I'm showing you on your screens right now. The fundamentals of the company over the past few years. So this is, I'll of course reveal the name in the next slide, but this is how the fundamentals, a snapshot of the fundamentals of the companies. It looks like this. EPS per share. Company has done well to grow its EPS from 1.7 rupees to almost 7 rupees between FY16 and FY20. I am leaving out FY21 because it was a pandemic year and therefore the businesses were affected. So the EPS has grown at a good clip. It grew in FY17, in FY18, and if FY19. FY20 it again fell slightly. So those are the EPS numbers. It's a debt-free company. It has a zero debt to equity, not just in the latest financial year, but over the last 3-4 years as well. So it's done well on that front. In terms of the ROE, in terms of the capital efficiency, the maximum ROE, despite the company growing at such a strong pace, is only 10%, and a minimum ROE of minus 0.3%. And an average ROE of a pretty average 5.3%. Now, what is the price to earnings multiple that you would give to this company based on this performance? I have a simple thumb rule when it comes to giving price to earnings multiple. If it's a low growth company, I usually don't pay a price to earnings multiple beyond 13-14 times. If it's a low growth company and if it's fundamentals are good, balance sheet is good. If it's a medium growth company, the price to earnings multiple that I believe in paying is anywhere between 14 to 20, 21 times. And if it's a high growth company, I would pay a maximum of 30 times and not more than that. Now, where would you put this company? I think I would classify this company as a medium growth company, but for argument's sake, let's say that this company deserves a price to earnings multiple of 30 times. So a 30 price to earnings multiple and an earnings power of 7 rupees. If you look at the EPS, you see that FY18, 19, 20 it has done well. And if you consider the highest EPS between those 3 years, it's 7 rupees. So let's assume that it has an earnings power of 7 rupees per share, a price to earnings multiple that it deserves, which is 30 times. So this company, I think, should be bought if it's available below 150 rupees per share, because the intrinsic value of a company, 30 ka price to earnings multiple, 7 times EPS is around 200 210 rupees per share, and you want to have a certain margin of safety, which in this case is say 25-30%. So if it's available at 150 rupees or below, only then you can consider investing in the company. Otherwise, it can be safely assumed that all the positives are factored into the stock price, and it's not, from a risk reward perspective, it's not a great pick. So here's the name of the stock. The next slide. The company is none other than Delta Corp, which is India's largest casino company. It has casino operations across a couple of states. So the company is Delta Corp. And when I did this study, which is about a couple of days back, the company was available at a price to earnings multiple of 41 times. Our aggressive estimate pegged the price to earnings multiple at 30 times, but this was available at a price to earnings multiple of 40 times. Now what this tells me is that the news which my friend shared with me, I think, is well known to the market. Markets have already factored this into their assumptions, and as a result of which the stock is trading at a price of rupees 300 and a price to earnings multiple of 40 times. So therefore, from a risk reward perspective, this looks a little difficult to me when it comes to making good money from the stock over the next 2 to 3 years. At the current valuations, I will give the stock a pass because it is expensive, and the news that the friend shared with me no longer matters, because I think it's already priced into this current market cap of the company. Now the reason I was able to arrive at this conclusion was because I tried to apply second order thinking. Like my friend, I did not just straight away jump to the conclusion that because this news is positive for the sector, this news is positive for the company should go up. And this is what you should always do. Always try and employ higher order thinking. If you have to have a chance of putting a superior performance in the stock market, you have to figure out whether the news out there is already priced into the stock price, or you have to have at least a cursory look at the fundamentals of the company, at the valuations of the company, and only then try and take a decision. So doing this, at least I was able to come to the conclusion that this stock does not merit a further look at the current valuations. Maybe I'll have a look at it again once it falls 30, 40, 50% from the current price. So at least from my perspective, the risk reward is definitely not in favor of the investor. Now, of course, this should not be construed as a recommendation. This is just my views, my opinion on the stock, and you are advised to do your own research when it comes to taking a position in the company. So yeah, that was how one can apply high order thinking when it comes to analyzing a stock. It's a very useful tool. It's a very practical tool, and I think it could prove to be very, very useful to you in the years ahead. So do use it, and also do let me know what do you think of this video. Your feedback, as usual, is very, very important to us. So do keep it coming, guys, and I'll see you again next time. Thank you so much.
Our new research uncovers some shocking truths behind today's hottest investment opportunity, electric vehicles. Don't invest your money in EV stocks before seeing our research. Click here to sign up for our special event to know it all for free.